Jonathan. I'll start you off today's training. Kindly allow me to share my screen shortly. I believe you can all see my screen. Someone can confirm.
Yes, we can.
Okay, thank you. So, members, first of all, we do appreciate your presence today for today's session. We believe it will be an eye-opener, and as well as it will be able to make members plan themselves for retirement and also know as an option which they should be having at the point of retirement. So members, this is our 12th edition, and I believe for those who have been with us all through, you have learned something. For those who are joining today, we appreciate you as well, and feel free to ask any question in relation to what we're going to present and in relation to things which are, that we might not have handled for today's session. So thank you very much. I know my colleague Elizabeth, she has handled the part of who is Octagon, and for that reason, I'll just request, wish to start something that is the services for Octagon Africa. Basically, is that we offer what we call employee benefits administration and consultancy. That is basically we have our retail product as well as our occupational products. So that falls our the administration service. Also, we have the insurance wing, which is under the Octagon Insurance Brokerage, which of our services that is which is both life business and as well as general business. Currently, they are underwriting premium of about 800 million USSD in terms of premium. Other option is that we have actuarial services, so that is consultancy as well as actuarial evaluation. And then lastly is training, whereby we have trained members as well. I think part of this form under the training wing. So today, members, we just wish to touch on retirement access option. So just to start it off is that members, as all of you, you have known that you find that retirement or saving is just a journey like any other saving. However, this is the goal, whereby you have a goal that your goal which is set in place is for you to have savings, to have pension at the point of retirement. That's just to replace what you are receiving as salary today with a pension income at the point of retire. So it is just like saving for today for the purpose of tomorrow. Just to give, just to touch something is that I remember while you were still young, you find that people used to think that I think all the previous generation used to believe that their investment or their savings is having children, having number of children. But you find that right now things have changed. You may have many children, but at the point they become family men, they have their own family, they'll just forget their own parents. Just giving an example, members, I think you can remember, I think one of our dailies, they had a report whereby a father sued his son for neglecting his duty. So you find for not taking care of them. So that is the issues which arise when you don't save, because now you are expecting that your kids will be taking care of you at the point of retire. But this has changed because the life has changed. So it's a reality that we need to embrace and save more. So for today, members, you're going to basically touch on what will be your option at the point of retire. How can you access your benefits? And that is why I'm going to start off with what we call retirement option. Uh, just to highlight is that at the point of retire, depending on the type of scheme you're saving into, remember that when we talk about pension savings, we have two ways in which a scheme can be set up. We have a first one which we call a provident fund, and the other one which we call a pension fund, which a retirement benefit scheme. So you find that in terms of management, those are just the same scheme. There's no difference that in terms of operation, the regulator just remain the same. The only difference is what we call access, how you are going to be paid your benefits. So in what we call a provident fund is that you find that members have an option of accessing their benefits, all of their money as a cash lump sum. You are taking all your money as it is. If you have saved less taxes, if, for instance, if you have saved 2 million provident fund, you can make just decision to take that 2 million and less taxes and be paid as a cash lump sum to your account. It has that option. Alternatively, in that provident fund, members can choose like, okay, for me, I don't want to take full of it, I want to take part of it and convert into giving me something like a monthly, while the other portion to remain as a to be paid in a cash lump sum. So that falls under what we call a provident fund. So a provident fund, it allows members to be paid their benefits in full with less taxes. The other alternative, the other type of fund is what we call a retirement, what we call a pension fund. That basically is a scheme whereby if you are going to be paid, a third, well, that is one of that of your pension benefit will be paid as a cash lump sum, while the remaining 2/3 will be used to purchase either what we call an income drawdown or an annuity. And that is why it forms our main focus of today in how you are going to handle that portion of money that we consider to be used in purchase of an income drawdown or an annuity. Something to mention is that no matter which option you take, no matter which option your scheme is, either it is in a provident or it is in a pension fund, both of them allows members to purchase an annuity or an income drawdown. And that becomes very important to look into that option of what are these two options whereby members are being told. So it is basically, let's say, for example, members, you have been in employment, monthly you have been receiving salary. Remember that at the point you retire, that marks the end of that salary. That is a reality. That the end of salary employment will mark even the end of, if you used to be having a medical cover, that marks the end of it. And if you used to have other benefits, that marks the end of it at the point of retire, because you are no longer in service. So you need to think about what is the alternative. So if you want to replace this monthly salary you have been receiving on monthly, it is by purchasing either what we call an income drawdown or what we call annuity. This just will provide you a monthly payment depending on type of arrangement. So just to give you I wish to skip that one, just touch in what is an income replacement ratio. An income replacement ratio is a person's gross pension after retirement divided by his or her gross income before retirement. So it is just saying your current pension, what you are receiving on monthly, you divide over by your last payment salary. For instance, let's say when you purchase this income drawdown or annuity, it will give you 60,000 and your last salary is 100,000. So your replacement ratio is 60%. What is the desired replacement ratio in Kenya? It is desired to be at 60%. However, looking at where we are currently with the savings of whereby you find that the only savings I think currently you are about 18% in terms of pension. So you find that even the saving culture is very low, very poor in Kenya, and you find that the income replacement ratio in Kenya is always below 30%. How can we do this? By saving more. So when you are thinking of saving, think about that replacement ratio. How much are you going to replace? So, and for you to arrive at that, you need to save more today. So just to touch on the two products whereby you find that I think what I've highlighted is that these provide monthly payment. So we have two products, that is annuity and an income drawdown. And for the purpose of what we call an annuity, I'll give my colleague Jonathan who will take us through the annuity, and then I'll come and handle the part of an income drawdown. Thank you. I'll hand over to Jonathan to take over from there.
Okay, thank you, Komen. I think you can all see my screen. Kindly confirm, Elizabeth.
Yes, we can.
Okay, thank you for this opportunity. I'm going to take you guys through annuity. My colleague has talked about the options that we have at retirement, and one of them is an annuity. So an annuity is a product that you purchase from an insurance company, and basically it's a payment that is paid to you as long as you live, yeah? and you can only purchase it when you attain the year of 50. Yeah, and it's always subject to a minimum of a guarantee period. So what an annuity is basically is that it will protect you from running out of money. We've had instances where retirees come and they take a lump sum, and in like 2-3 years, the fund has been depleted. Yeah, so we have these monies transferred to an insurance company, and this means that you'll transfer this risk to an insurance company, and this insurance company will be paying you, let me call it a salary, each and every month for the rest of your life. Yeah. So let's look at the type of annuity. I'm going to tackle 3 types of annuities. Which we have single life annuity, which these annuities, which the annuitant takes up the annuity, and he or she will be paid fixed intervals, a certain amount of money at fixed intervals for the rest of this person's life, and is subject to a minimum guarantee period. Yeah. We also have another one which is called joint life last survivor annuity. Yeah. This one provides an income for life to the partners in marriage. So if a spouse takes up the cover and chooses a joint life last survivor annuity, and then God forbid, after let's say the 5th year, he or she passes on, the spouse will continue earning these monies for the rest of that spouse's life. Yeah. So we have another one called reversionary annuity. This now can extend to up to the children upon the death of an annuitant. So that's the difference. The single life annuity is for only the annuitant. The joint life spouses, these are partners in marriage, and then the reversionary annuity can be extended to the children until these children attain a certain age. Yeah. Now, for an annuity, when you approach retirement, we'll quote for you the annuity. And some of the requirements that we need for us to quote an annuity is the age, that's the date of birth. We'll also need the gender and the purchase price. Yeah. So as we all know, women outlive men. Yeah. So for this annuity, the reason why we like the age, the gender, is because if you compare 2 quotations with the same purchase price, with the same age, but for a male and a female, you'll notice that the monthly payouts to the male person will be more than the female. Yeah. So in a quotation, we'll have the escalation, and then we'll have the guarantee period and the reversionary factor. Yeah. So the escalation is the percentage increase in the annuity payments every year. So if you take up an escalation of, let's say, 5%, this means that the monies that you are being paid every month will be escalated at 5% each and every year. Yeah. So there'll be different payments. The first year will be different from the second year, from the 3rd year. They'll be escalating. Yeah. And then there's a guarantee period. So this is the minimum period that the annuity payments must be made, whether the annuitant is alive or has passed on, for the purpose of protecting the purchase money. Yeah. Let's say, for example, you take up the cover now, and you choose, let's say, a guarantee period of 20 years. Yeah. Then, God forbid, the annuitant passes on at the 5th year. If you calculate the monies that this annuitant has been paid since the 1st year to the 5th year, you'll get that these monies will be definitely less than the purchase price. Yeah. So for this guarantee period, we'll be having, let's say, 15 years guarantee period. So these 15 years, the beneficiaries will be paid the money totaling to the 15 years that have remained in the guarantee period. Yeah. And then we have the reversionary factor. This comes on to the reversionary annuity or the joint life plus survivor annuity. Yeah. So this is the percentage of annuity income that translates to a surviving spouse or child under a reversionary annuity contract. Yeah. So you can decide to take up the reversionary annuity, but at a certain percentage. Let's say if you pass on, your spouse will be paid either 100%, that's the normal payments which you've been getting, or it can be reversed to 50%. Yeah. Now, this is a sample of a quotation for one of our clients. Now, you can see we need the gender, the date of birth, and the purchase price. Yeah. And then we have the guarantee period, we have the escalation on this side, and then we have this is single life, this is joint life, last survivor, 50% reversion, joint life, last survivor, 100% reversion. Yeah. So what happens when you approach retirement? We'll provide such a quotation for a minimum of like 5 insurance companies. Yeah. And then we'll sit down with you, go through each and every quotation, look at all the insurance companies we've gotten quotes from. We look at how they pay their retirees. We look at their financial muscle, if they're able to pay these monies for the rest of your lives, which mostly is between 20 to 40 years. So that's what we do. Yeah. And when you take up an annuity with Octagon, we have a value add, which is the retirement medical policy, which we have partnered with Jubilee Insurance. We offer an affordable healthcare plan to retirees, and this can be financed by these annuities or the drawdown that my colleague was talking about. And when one approaches retirement or is at the age of, let's say, above 60 years, it's usually a challenge to get a medical cover, which is affordable, which will take care of your family, gives you a peace of mind that all your medical expenses will be catered for. So we've negotiated good rates with Jubilee, and you can be able to join our medical cover and be able to be covered for up to the age of 85 years. Yeah. So I think that's the end of my presentation. Over to you, Comment.
Thank you, thank you very much. Thank you very much, my colleague Jonathan. Jonathan has just touched one option of retirement, that is whereby if a member chooses an option of purchasing an annuity, and he has elaborated what is an annuity, what are the options of an annuity. So we would wish to look on alternative of an annuity. As mentioned by Jonathan, that an annuity will provide that monthly pay the rest of your life. Also, he has mentioned that an annuity will, when you take your money today, you put in an insurance company, they guarantee you to make that monthly payment the rest of your life. And basically that means that once you give insurance company that 1 million, their guarantee is to give you the monthly payment the rest of your life. However, if the member passed on at that point, that marks the end of it, or in case if it is a joint annuity, it might continue, but remember that the principal amount will never be paid back to you. That is now, that brought the issue of what we call an income drawdown, because you find that some people would say, for me, I would wish to have a arrangement whereby I'm receiving my monthly payment, but if I die at specific time or at the maturity, I can cash out a certain, not even the principal amount, but what we call, you can cash out residual value, what is remaining. And that brought up what we call an income drawdown. So just allow me, I enlarge my screen So what is an income drawdown? An income drawdown is a pension arrangement in which a member chooses to access his benefit in terms of a monthly pay for a period of time. So it is just a guarantee. It is just a monthly or a periodic payment over a period of time. And that normally that period of time is 10 years. So it's basically when you in a layman language is that you now, let's say, for instance, at the point of retire, you put in, let's say, your lump sum, or you want to, instead of being paid in a lump sum, you reinvest that money. It is being put under what we call an income drawdown fund. And from that fund, the member would be accessing monthly payment. He or she will be paid monthly payment for a period of 10 years. And at the end of 10 years, member would have something what we call a residual value. For instance, let me just give an example. Let's say today you put your fund under an income drawdown, and remember this arrangement is for 10 years. So if you put, for example, $1 million into a drawdown fund, and say you are going to be paid a monthly pay of 10,000 until you'll be receiving a monthly pay of 10,000 until year 10. So at the end of year 10, remember that this money was being invested. So it was earning interest at a certain percentage. And then you as the member, you used to be receiving a monthly pay over that 10 years. So there was injection which is in income, and at the same time you used to be receiving your monthly pay. So at the end of year 10, you're having something. It might not be $1 million that you have invested, but it will be slightly lower in case you have been accessing your money. However, in the situation that what are now the advantage of investing in a drawdown? One, it is flexible. Remember that the first arrangement, which is an annuity, is that it is a guaranteed fund whereby the insurance company will guarantee to make a payment to you. But for this one, a drawdown is that it is flexible. The amount you wish to access is always determined by the member. So long the member access between 0 to 15%, the amount you are drawing down, the one which you are being paid on a monthly, should be between a range of 0 to 15%. Secondly is what you call rolling back of investment income. So remember that this is just a fund whereby you have just put your fund for reinvestment. So it is being invested, and the return that fund is making, it will be distributed to your fund, to your investment. So you find that will. Okay. So the second advantage which I'm trying to mention is what you call the rolling back of investment. So as members now is that remember that you had put in a certain amount for investment. So on yearly basis, this investment will be giving a return. And in that return, it is being distributed to the members. So let's give, for example, that you put $1 million, in the first year, it earned a return of 10%. So what is 10% of $1 million? That is close to 100,000. And at the same time, the same member, in the same first year, he was paid a monthly payment, which is of 10%. So to mean the member is accessing 10% of the fund of the injected fund. You had put in $1 million, and then you're accessing 10%, and the income from that investment is 10%. So at the end of the first year, you find that this member would be having $1 million still remaining, because what he was receiving on monthly basis is 10% of the fund. And the fund at the end of the year, it earned at 10%. So that is what the functionality of rolling back of investment. So you are just putting your funds for investment, and it is earning interest, and the same is being allocated to members. That advantage is that most members do not prefer insurance companies. You find that those are preference, whereby you find that people say, for us, I don't want to be in a guarantee fund whereby I'll not get, you are just guaranteed me a monthly pay for life. However, my preference is not going with that option of an insurance. Fourth is what we call better pricing. So it becomes very important when you are considering to be paid on monthly, whereby it's good to ensure, remember that this is just a reinvestment of fund, and it will be earning you a monthly pay, and it will also earn an interest. So if we do a better pricing, whereby you will be able to see that, okay, what was injected, what I put in was this amount, and what I'm receiving is this amount, and what was the return that this investment earned is this figure. So you find that in this fund there is transparency, because at the end of the year there is auditing of that fund. We do audit. Also, members are being taken through how the audit report during the AGM. They're being informed about the investment, where the funds are being invested, what was the overall returns, and what was distributed to the member. The fifth, which is the most important, is that principal is always available to the members or beneficiaries. Having mentioned that this is a 10-year arrangement. So it means that if you have invested $1 million, at the end of 10 years, you have a principal amount. In case you access what you have been receiving on monthly is lower than than the interest, you find that at the end of 10 years, you might be having higher figures or higher residual figures than what you had invested. So that brought the option situation whereby I know, which is a very concern, is that what will happen to this money when I pass on before the maturity or before the 10 years? It will be always available. Remember that this, you'll be receiving a yearly statement at the end of every year. Members will be receiving that statement. You will be able to see. So let's say if a member passed on at year 5, what is remaining at year 5? Let's say you have a certain amount which was remaining at year 5. Members would now, if a member passed on, the beneficiaries will have that, will make that decision of one, either to continue with the drawdown until the end of the period, or option 2, whereby the beneficiaries would choose to cash out their money. Let's say what was remaining at year 5 is a certain amount. The beneficiaries will make a decision of either cashing out. The last is this fund was introduced in 2016, and it is being regulated by Retirement Benefit Authority. What are the key features of an income drawdown? One, it doesn't have a guarantee. No, it is not guaranteed, and it's what the return is determined entirely dependent with the performance of the underlying investment. So you find that brings the issue of always, if you wish to go with this, what we call an income drawdown, consider a stable fund. A stable fund is a fund whereby you are consider a fund, look at the asset allocation, because it should be a conservative investment. And when you talk about a conservative investment, is basically it should be invested in most majorly in government securities, and that will really protect the interest of the members and ensure that members are receiving high returns, so that at the end of 10 years you have good, adequate remaining. The second, which is flexibility, having mentioned that in terms of that monthly payment, you are the one to make decision how do you wish to be paid. So as long as it is between a range of 0 to 15% as provided by the regulator. The other item, which is the risk to this investment, is always what we call investment and longevity risk. You find that in the situation that members don't pay attention on how much you are accessing on monthly in comparison to what was the return. For instance, if someone is accessing at 15% and the fund is making a return of 10%, so you find that you are always accessing more than what the fund is bringing or what the income the fund is making. So if you invest $1 million and you're accessing at 15% and the fund is making 10%, you find that at the end of 10 years, your 1 million will be at the end of 10 years will be less than $1 million. Reason is this, because you have been accessing more than what the fund is making. And that makes it very important because of that flexibility. As a member, always consider that you are accessing either at the same rate as the investment return or lower, so that you can protect your principal investment. Another, which is always a risk, is that you find that in case you access more, you might end up withdrawing all your money. So among the requirement is that one, it is regulated by RBA. Secondly, is that the monthly payment should be within the provided limit by regulator, that is at 15% per annum. So it means that what you're going to be paid on monthly should be between a range of 0 to 15% at the maximum. The period is 10 years. I think I've mentioned that. And you must finish that 10 years for you to either at the end of 10 years, you can make decision either to cash out your money or you can continue with the plan. Another one is that it is regulated by Retirement Benefits Authority. The last is what we call recommended actuarial review or review of the fund is done after every 3 years. So up to their members, I would wish to stop, and for the interest of time as well, I would wish to stop there so that we can take possibly you can take questions from you from members so that can be addressed. Thank you.
Thank you. Thank you so much, Komen and Jonathan. That was very insightful. We have a few questions on the conversation tab of our meeting. So anybody else who has a question, you can raise your hand and also put in a comment on the conversation section. But P. Wambogo had his hand raised from when the meeting began. So P. Wambogo, I've enabled your microphone. I don't know if you can be able to ask your question. Okay, I see he's very active on the conversation section. So the first question that P. Wambogo asked is, what does that mean that the minimum drawdown period is 10 years?
Thank you very much. I'll address the first question, that is, what does that mean that the minimum drawdown period is 10 years? So income drawdown is a 10-year arrangement. So let's say if you invest in today, it will run, you'll be receiving, it is a plan that will run for the next 10 years. So if you invest in today, the time you'll cash out or you'll have your residual value or you cash out what is remaining will be after 10 years. So it basically means it is an arrangement of 10 years. So it's supposed to run for 10 years for you to either exit or continue for another period of 10 years, or you can cash out and purchase an annuity. So it just basically means the arrangement runs for 10 years. I'll go to the second question, which is someone has asked, is there any difference in taxation between an annuity and income drawdown? Is that the taxation of an annuity and income drawdown are taxed similarly, whereby you find that would be anyone, the normal taxation until age 65. However, from age 65 and above, you are considered to be a senior citizen and you're given exemption on a monthly pay. None of you would be taxed. So in terms of monthly taxation, they're being taxed similarly. I proceed to the other question. Can a member cash out 100% upon attainment of retirement age? I think that is retirement age. They can buy goats, camels. That is in case they want to fully manage their own fund. Thank you very much. That is very, very important question for the people who are preparing to go for retire. Is that for you to, having mentioned that at the first stage, is that all the time know which type of fund or which structure of your fund your scheme is. Which structure is it? Is it a provident fund or it is a pension fund? If it is a provident fund, you can cash out 100%, but you must pay which is now taxes. Let's say, for instance, you have 10 million, you'll pay tax and then you receive a net if it is a provident fund. Alternative, if it is not a provident fund, it means that it is a what we call a pension fund. And if it is a pension fund, you will not access 100%. You as a cash lump sum, you'll be allowed to access a third, that is 1/3 of your fund as a cash lump sum. While the remaining, you will use it to purchase either of the two products. You choose. It will be upon you now to make decision whether you are going to buy an income drawdown or you will buy an annuity. So that is very key. So what I'll just mention for Wambugu is that first of all, understand the structure of your fund where you are investing currently. If it is a pension or it is a provident fund. If it is a provident fund, to mean you have that option of accessing 100% less expenses. I'm very happy you are a farmer. You are a farmer. You rear goats, cows. I wish you well. One day, I know you're a bit, probably might be senior. So one day we'll come and take Mbuzi Choma. There's another question is what are the risks to investors in annuities given how sometimes companies shall fall? Is that that is very crucial as well. Is that whenever you choose provider for your annuity, consider a well established insurance, which you look on the reputation as well, so that at the end of the day, remember that it is guaranteed by that insurance company. But in the situation that is under, it's also a risk to the investors. But the good thing is that in terms of regulation, you find that the regulation currently is you find that the regulation which IRA, which is regulating the insurance industry, is very, very strict in terms of how this insurance company are investing, and they are known where they have invested their funds. So in most situations, you find that the members do not fully lose out, because at the end of the day, if it is all of these investors or insurance companies can either invest in government security or even whereby you can easily attach it to something. So at the end of the day, you not lose it fully. But it is very key as investors, talk to our insurance team. At least they'll guide you through. At times you find that you might be advised not to go with the one with highest monthly pay and go with the one with a lower, but considering the stability of that insurance company. So that becomes very, very key. Thank you very much. I believe I've handled much of your questions. I'll hand over to Elizabeth.
Thank you so much, Wambogo and Supriyo Sengupta, for your questions. We will continue taking any other questions that you guys might have. The conversation chat box is still open. You can type in there, and also you can raise your hand and we will enable your microphone so that we can hear you out today. Anybody else with a question? Now is your chance. The conversation box is still open, so if you're feeling a little shy, just type in your questions and we'll be glad to answer them. Okay, it seems that all of you have fully understood the topics that we were discussing today, and I'm glad that has happened. Oh, yes, we have a question from Stanley Chepto. Can a provident person purchase an annuity?
Thank you, Stanley. For a provident person, they have that leeway, or they have an option of purchasing an annuity or an income drawdown without any restriction. You are the one to make decision how much you wish to put in an annuity or to purchase an annuity or income drawdown. For example, if let's say for the other point, let's say if someone you have saved at you're saving under a provident fund, you attain retirement age, you have saved something like 5 million. So it is upon you in a provident fund, it is upon you to choose how much you are going to use it to purchase an annuity or an income drawdown. You may wake up and say, okay, for me, I want to put 4.5 million into an annuity or income drawdown, and the remaining you pay me as a cash lump sum. So you find that in a provident fund, it has that advantage whereby members can make decision how much they can use to purchase an annuity. They are not restricted like in a pension fund whereby you must take that as a cash lump sum, while the remaining to that you use it in purchase of an income drawdown or an annuity. Thank you for that question. I believe you are.
Thank you, Komen, for your answer. Thank you, Stanley, for your question. Piwambogo also said that thank you, your answers were clear. In case anyone else has any other question, feel free to drop in our chat on the conversation box. You can also send an email to us on training@octagonafrica.com. Komen and Jonathan, as they figure out the questions they want to ask you, I'd appreciate if you guys can give us your closing statements.
Allow me go first. My closing statement would be, members, I really appreciate this opportunity you have given us to take you through this session of retirement option. I believe it has been an insightful moment, and you have learned something. So we believe I believe we'll interact more. By contacts, our contacts will be shared with you, so that in case you have any other question, any other burning issue, or anything that you wish to understand more in relation to your pension matters, you can reach out to us. And it's pleasure meeting you today. Thank you, and have a blessed evening. I give my colleague to make his final remarks.
Okay, thank you, Michael. And I would like to thank the members for joining this pension clinic. I hope that you guys have learned something as you head to retirement, and I'll be waiting for those quotations. Okay, thank you. Over to you, Elizabeth.
Thank you so much, Jonathan. Thank you so much, Komen. Honestly, I've also learned so much from your presentations. Thank you, members, for honoring our invitation. Once again, we usually hold our pension clinics every second Friday of the month. So we're going to be having the next pension clinic on 18th of February this month. I've seen most of you saying kindly send us the presentation. We will do that. We have your email addresses from when you registered. Also, we usually upload these sessions on our YouTube channel. If you want to go back and have a listen again, our handle is Octagon Africa. You can follow us on YouTube, and we're going to upload this. Once again, thank you so much for your time. We know it's on a Friday afternoon, and you probably had a lot of things to do, but you chose to join us, and we truly appreciate that. In case this time is not usually good for you, in case you are available during the mornings, kindly let us know, and we will schedule the presentations and the trainings when you guys are available. Having said that, once again, if you have any other burning issue, reach out to us on our email, training@octagonafrica.com. I will put it down on the conversation section, and I will also put down our number. And having said that, I will allow you to leave at your own pleasure. Thank you. Thank you so much for being here with us.